Hey, Tom Hegna here. About a year and a half ago, I wrote an article on my blog, The 60/40 Portfolio is Dead, Long Live Life Insurance and Annuities. And so I thought I would just kind of use this video to go through what I wrote. You know, a lot of the people that I've spoken with recently have talked about how Don't Worry, Retire Happy has dramatically changed the way that they and their clients think about retirement. Financial advisors need to adapt and stay ahead of the trends. There are so many traditional views of the proper way to retire that have worked for 40 or 50 years. You know, even as recent as 10 years ago, these strategies may have been successful. But do all of these strategies still ring true today? See, traditionally, we've been told to accumulate wealth and manage risk by investing early and often into a 60% stock, 40% bond strategy. So let's take a look at the 60/40 strategy and some alternatives that may be better suited in today's environment. People have understood the 60/40 strategy to mean that during the accumulation phase, you are supposed to invest 60% of your portfolio in stocks and 40% in bonds so that your market risk is minimized. Typically, every few years, you would go to your advisor and rebalance your portfolio. Now, while this is better than doing nothing, I would argue that this is very far from being the optimal plan in retirement. See, for years, our parents and grandparents turned to bonds as they were the most secure way to minimize their market risk. Have you looked at the yields on bonds currently? Currently, the 30-year government bond is yielding 1.6%, and the 10-year treasury is about 75 basis points. Look, bond yields are at historical lows and aren't poised to make a big comeback anytime soon. Don't believe me? Read the Federal Reserve's recent speech transcript. You know, with bonds yielding under 2%, the 60/40 portfolio strategy really doesn't make sense. Plus, if interest rates do increase, the value of bonds plunge. So there's really no upside potential at 2%, and there's huge downside potential of 50% or more. So what's the solution? Look, if you or your clients are still in the accumulation phase, so 55 and under, use whole life or another cash value life insurance policy as a bond substitute. It pays more, typically 3 to 6%, a traditional bond rate, but it doesn't have that interest rate risk. If interest rates go up, the value of the policy does not go down, it keeps going up. This is a concept that even sophisticated investors can use. Additionally, they get protection of life insurance for their family. In this 1% interest rate environment, nearly everyone is underinsured. For younger generations, it's vital to change the generic perception of cash value life insurance now so that they're protected during their retirement. And once you can understand the benefits as a bond substitute, the value of protection, the cash value benefits, and the tax advantages, then these cash value products become a no-brainer. Especially since you got a tax-free death benefit and tax-free withdrawals, you can see that this is a great tax diversification vehicle as well. Again, something that makes sense to even sophisticated investors. Now, if you're in the distribution phase, 60 and above, replace the bonds with guaranteed lifetime income. The income annuity gives you basically, it functions like a AAA rated bond with a CCC rated yield with zero standard deviation. The payout rate returns that the lifetime income annuity provide do not exist in the markets. If you were going to go out and try to duplicate this type of product in the stock market, it would not be possible. Why? Because it's all about the mortality and longevity credits. Add in the tax advantage that comes due to the exclusion ratio for non-qualified money, and a lifetime income annuity becomes a powerful alternative. In fact, I wrote a recent white paper entitled Retirement Alpha, How Mortality Credits Improve Retirement Outcomes. And this explains in detail how these mortality and longevity credits are a new form of alpha that you can't get from stocks or bonds or real estate. Again, the sophisticated investor can grasp these concepts. Look, retirement is all about managing risks optimally. Optimal simply means it's the best more often than anything else will be the best, and it'll never be the worst. You know, the definition of insanity is trying to do the same thing over and over and over and expecting a different result. What are you and your clients doing differently to produce different and positive results? I would strongly encourage you to look at a 60/40 portfolio, 60% stock and 40% either life insurance or income annuities. I think you're going to have a much better result for your clients in both the accumulation phase and the distribution phase. I hope you found this helpful today.